welcome back to the Don and Gino Real Estate and Finance Show right here in your hometown station, AM 1220 KHTS.
And remember, our goal is always to guide you to personal and financial wellness.
Super excited to have you join us again on the Don and Gino Real Estate and Finance Show. For 8 years, we've been guiding you to personal financial wellness. We love this part of our week every single week, and we brought in the best professionals we can find. You can find our interviews. We're talking over 1,000 interviews on our YouTube channel. Go to donandgino.com. You'll see the videos right there, the National Real Estate Cafe, our daily blog, or go to our YouTube channel and pull up all the videos. Actually, we're working right now to categorize them, and our guest today probably has about 36 of the videos on financial planning and financial awareness, and we have him here today, Mr. Chris Ingram with Ingram Financial Solutions.
Thank you for having me, as usual.
So earlier we were talking with Chris about customized solutions and kind of whole financial planning instead of just stock trading. Mm-hmm. And that's something I know from experience that you did for us, at least for my family, and I know that you do for all your clients. Mm-hmm. And it makes me feel like I could sleep at night because I know that I'm planning better than if I just planned on my own. If nothing else, an accountability partner.
Mm-hmm. I know Gino needs one.
It's true. Hey, most people do, right? All the most successful people in the world have coaches.
We have ours,
yeah, for sure.
So it helps me. It helps keep me in line, and we have nice chats too. Like you were saying, we're friends too. We can have conversations about, like we were talking right when you walked in. I'm like, man, this economy's got some legs. Mm-hmm. It looks like this might be a real juggernaut of an economy, and it might not just crash like everybody's been asking for.
Okay,
for sure.
Good glass of wine, some nice legs.
I'll leave that alone. So what are your feelings about it? I mean, have your conversations with clients changed from the fear mongers of Q4 to the change of, did I miss it? Did I miss some opportunity?
For sure. I had some difficult conversations with clients during that fourth quarter. And I actually had a client in a conversation 2 weeks ago maybe. And he basically apologized, said, I'm sorry, don't ever listen to me again. I was like, well, now that we cleared that up, it'll be better going forward.
Gino says that to Nella all the time.
Yeah. Not so much.
So, fourth quarter was weird, and I don't know if there's a video out there that we could go back to and show, but, talking about the fourth quarter and what was going on, the fear of a recession really was all riding on the fact that the Fed came out and said it was going to be so aggressive with raising interest rates that was essentially going to put us in a recession at some point in the future. And so these recession fears became so overblown. It was almost like a foregone conclusion that we were going to a recession. But what was crazy about it is that it really all hinged on what was the Fed going to end up doing, and he made some very rash comments that I think he figured out real quickly. Oops, I shouldn't have done that.
So you think
we go through this all the time because we've been in this industry so long now. We've gone through a few Fed chairs. Every single one has to learn how strong their verbiage is and what their words mean and how it affects the economy.
I even made up a sentence for it.
You did.
Every time someone smart says something stupid.
Right.
Right. And they don't, but they want to, puff their chest out and say, I got this and I'm going to control this, but they don't realize what their words say, positive or negatively.
Right.
And they've done this to us where they throw out, I got this and I'm the man, I'm going to show you I'm taking care, and it scares the shit out of everybody.
Yeah. I mean, you're talking about the market was almost thrown into a 20% pullback on this fear.
Well, it did. You go from September 21st till the day after Christmas when the Dow Jones bottomed and then turned midday. So S&P from September 21st to the day after Christmas, we were down, I think it was 20.23%. So that's a big,
bear market signal,
huge pullback. And if you actually look at a lot of other indicators, and I won't go into all of them, but really the only other two times that we've seen that is right around 2000, and it happened again in 2008. So we were signaling something really, really catastrophic was coming and that the market was going to continue to slide out and things were going to get horrible. That's how bad it looked. And
Well, a lot of people
when-
jumped on that bandwagon too, hoping that they'd be the one right saying "I told you so," and we didn't see it.
No,
in
but
all
we
those
took
charts.
a more defensive stance. We had conversations about it. We
For
did
sure.
a show.
Well, you,
and we said,
you
hey,
kind of
just in
have
case.
to. You have to, because the indicators were showing you that this thing was going to continue to spiral out of control. But the whole time and now it's funny, you listen to people and they're like, oh, I told you so. And, but the whole time you're watching it happen, you're going, I don't see it. And that's where I say you could find a video. I guarantee I'm on here around that time period going, I don't see it. The economy looks too strong to me for us to go into a recession in the tail end of next year. And maybe the Fed can put us there, but it just didn't seem like there was enough data to support the recession talks that were going on at that time. And so, of course, what happened? Fed raises rates in December. I think really that was a stand that he made against the president, because
Sure.
the president said you absolutely cannot raise rates this month.
You shouldn't, because the economy.
And he just did it to say, hey, I'm not under your control, and I.
But
can
at
do
the
whatever I
same
want.
time, he definitely changed his tune.
Well, immediately
Right
after
the day
that-
after,
well,
yeah.
So the credit markets.
yeah.
I think was the big signal. When he made that rate hike, the credit markets are what said that was absolutely the incorrect call and it was a mistake. And I think he immediately came around and changed his tune and said, hey, we're going to take this wait and see approach and let's hold off for
Well,
now.
I love the comment that they make is like, some of the comments about why they were getting so aggressive. I love this one is where he's like, well, we have to sometimes be aggressive and raise rates high enough so that we can lower them when the market slows down. We're like, but if you're the one causing it to slow down, that doesn't work.
Now, wait a second.
But you do need...
You have to slow it down. You can't be overheated.
No, I'm okay
And
with
I
that.
agree, but
he was so
to
aggressive.
cause and then pull,
And
yeah.
the problem was, he said, I'm guaranteed, regardless of what's going on in the economy, his verbiage was, we're going to raise 3 times next year, 2. How do you know where the economy is going to go? We're already seeing some slow down.
Right.
Let's not crash it by just raising rates for to be on your own agenda.
Right.
And luckily he did change his verbiage. And like I said, they have to learn. They have to learn how their verbiage and their direction affects the markets. At first, they just want to puff their chest. We've seen it every time. Every time one of them goes out and says something overly aggressive and scares the markets.
Right. So needless to say, he changes his tune. Market rallies. Market, is the famous line, and it's been this way since 2008, which it really shouldn't be this way. It's kind of annoying from my perspective, being a manager of wealth for clients, but the don't fight the Fed.
Yeah.
But it's kind of irritating that the Fed is so powerful when it comes to what the markets have been doing, and it's because they've been so involved since 2008 and the beginning of quantitative easing and all of those programs. And there were times where the data would come out and it was good and you would think the market would rally, but the market was actually dropping because it was a sign that the Fed may raise interest rates. This counterbalance, it was just pretty annoying from a management standpoint, because you're thinking, this is counterintuitive to what we would typically look for. However, we're still in that place where it's don't fight the Fed, and if the Fed's not going to raise rates this year, that provides a lot of comfort to the market and a lot of potential for this market to rally.
So it's interesting, right? I'm looking at this, and I'm just going to tie it to real estate because it's what we live, breathe, and do all day long. But it's kind of the same thing, right? When you impacted the wealth effect in Q4, we've talked about it, anything over $1 million froze. Mm-hmm. They're like, whoa, I just lost 20% of my stock market. That was my down payment.
Totally.
So I'm not
it
moving.
affected that market anyways.
That
Those
market
with
the
a higher
most.
net worth because they had more money in the market to lose.
Yeah, and also, not to mention affordability. Interest rates had risen almost 1% in a very short amount of time. 6 months, that's way too much to swallow 3/4 or 1% in interest rate rise. And that together with the fear was so much to freeze the market.
Yeah.
But then, it's like we thawed out. All of a sudden, rates came down. The Fed changed its tune. Things are happening again. I mean, could we possibly be navigating the impossible soft landing? I mean, we saw a report this morning. We're talking about it on the National Real Estate Cafe. It's 4.2% nationwide appreciation. That's just about perfect.
Yeah, because it started off overheated almost 7% nationwide, and then it went down to 6.2, and then 5.5, and 4.7, now 4.2. And we've always said we want 3 to 4 is great Because remember, you're getting appreciation on the entire value of the home, not what you invested, but the entire value of your home. So it has been a soft landing to where we feel that the real estate market is still a great market for buyers and sellers. Now it's moved into a normal market, which we haven't seen in 2 decades, where buyers and sellers actually negotiate on the true value of the home and the condition of the home. We just did it ourselves. We just bought a home, and even 6 months ago, we couldn't negotiate anything. If you got the home, you got lucky. Now with the soft landing and buyers and sellers getting realistic, we were able to actually negotiate on the true value and the condition of the home because there was repairs needed. There's a time where you
take it the way it is,
as is. So now we're like, no, there's this and that. And now they're like, yeah, you're right. All right.
Right.
So the market's more normal now, and we feel that. So where do you see the economy going 2019?
I mean, I think the 2 biggest influencing factors is trade war, trade negotiations,
which seem to be making progress,
and still the Fed, because now everybody's assuming that the Fed's not going to raise rates at all this year.
That's a bit loose. I don't know about that.
I totally agree, and so that's where I say, this market is pricing in, hey, the Fed's just off the table. But I don't believe that's necessarily the case. So I think if you actually,
until June it is.
If you get an outstanding deal with China, pulls back tariffs that were previously put in place.
You see Apple rally, you start seeing individual companies.
You see that happen. I think the Fed uses that as an opportunity to say, hey, another quarter point. We still need to get interest rates higher.
What's with this hand slap thing though from the Fed?
It's a counter. It's this weird counterbalance between the two. But I think you start to heat up and you see some of those things materialize. And the Fed is not completely off the table, and how the market reacts to that will be interesting. So I think the Fed's still an influencing factor. I think trade negotiations are going to be huge. So how does that go? Right now, the earnings multiple is showing signs that we are in an earnings recession for corporate America. You completely unwind tariffs and come with an outstanding deal with China with regards to trade negotiations, and I think you add a point or two to that multiple for the year, and the market isn't pricing that in right now. So that gives a lot of upside potential to stocks. But at the same time, now you got the Fed that might step in and go, hey, we're going to use that as an opportunity to add a quarter point. And so do they counterbalance each other, or does the market continue to rally? So I think you're going to see this kind of fight back and forth, and it may continue to be a fairly volatile market environment. But I think when you put it all on the table, economy looks still very, very strong. I don't know if I'd say very, very strong, but it looks nice and healthy. Okay, you've got corporate America that everybody's already priced in an earnings recession, and that could improve with trade negotiations.
Part of that's because we saw a rise in minimum wage.
Yep.
Across the nation.
For sure.
Yep.
And you've got a Fed that is at least playing ball, and I think will be somewhat friendly throughout the course of the year. And then the last thing that I think is a huge influencing factor is that he has been quoted, our president I'm talking about, as walking into meetings, and his comment is, how's the market doing? And our president is 100% sold on the fact that his path to getting reelected is to have a healthy economy and a rising stock market. And so he has so much riding on the success of the stock market with his game plan of being reelected that he is going to probably do everything in his power to keep things moving higher.
Well, he's making sure that everybody else has a lot riding on it too, because they're heavily invested at that point.
So you can't just turn a blind eye to that.
You can't discount that. You can't discount that.
He's got a lot of power, and he's a guy who wants to see things go higher.
And he has a lot of power that maybe other presidents haven't had, because all of his friends and the group of people he moves with are the influencers in this country.
For sure.
That not every president has had that. Influencers in the stock market.
Right.
So I think he's got a unique influence in the stock market that others may not have.
I agree. And so I think that you put all of that together, and you've probably got a setup for a pretty darn good year. And most people will say, well, market's already up so much this year, can it continue? Yeah, because you had when you factor in, let's take the last 5 months, and you look at what the market did down and up, there's still room to pass to new highs and probably go up another 10-15% if things look look healthy.
That's
so
a little crazy, but okay.
it is crazy. But here's another thing, and I'm not a total historical person, but you have to look at them and take them somewhat into account. The best year during a presidential term for the markets is historically the third year of the term. Now, 2017 was a great year for Trump, and I don't know if he'll be able to outdo 2017, but this might be the year. And you put all those factors together, and you've got a market that's set up to probably have a pretty healthy 2019.
All right. Predictions by Mr. Chris Ingram of Ingram Financial Solutions. The 2019 outlook looks good.
It does.
And we agree.
Yep,
we agree.
absolutely.
And also we've learned being with you, Chris, it's nice as having you in our back pocket so that if there are adjustments that need to be made, you help us with this because you did help us take money off the table when the market did adjust. We were prepared.
Yep.
And we saw that. We're like, in one day, we're like, 19 of my stocks just got pulled, and we watched the market tank, and then
It was a good decision.
We're in a good position to basically then put it back in when the time is right.
Right.
Yeah,
So,
it's like I always say, I joke about it, but it's true. If I see Chris calling me, I'm like, excuse me, hold on one second.
yeah. Well, especially when
I'm always surprised when you don't answer. I'm like, this must be a
Yeah,
really important
busy,
meeting.
yeah.
You must be doing the radio show. All right, so how can they get a hold of you, Chris? Because more of our listeners need to work with a true professional and get some great advice.
Yeah, so the name of my company is Ingram Financial Solutions. Go to my website, ingramfinancialsolutions.com. It's got all of my information about the company, and look me up there.
All right. Great stuff as always, Chris. Thank you very much.
Thanks
and
for having
Thank you
me.
for taking good care of both our portfolios, and we look forward to having you back, buddy.
You're very welcome. Yeah,
All right,
thanks.
Chris.
All right. More of these great interviews at donandgino.com. We're always doing great interviews, so check us out, and we'll see you in the next interview.